We have Deepak Shenoy of Capitalmind who's joining us on the show right now. Deepak, good afternoon. Thanks for taking the time out. How do we go about, markets right now? How are you looking at rotation? What do you like and what are you getting rid of?
So it's an interesting point in the market. I think September end results will come in. We are looking at car and motorcycle sales, actually two-wheeler sales looking much more higher than we expected, considering this is one of those months where you have this Shraddh, pause in sales, which has typically been a pretty big player in the last 10 or 15 years. In terms of actual auto sales, but this time we're actually seeing a month-on-month increase in two-wheeler sales already, and we still have about 3 days left in the month. So there is a potential long-term story here when we're looking at two-wheeler stocks potentially with some kind of move up here, because we've seen some of these stocks traded multi-year lows in terms of price to earnings and also in terms of price itself. But on the other hand, I think right now the least attractive sectors to us right now is pharma, because it won't benefit quite as much from the tax cuts, because they have a number of R&D related expenses that they take a higher cut on, and those exemptions are no longer available if you want to take the 22% tax route. They also don't give them for SEZ. If you have an SEZ, then you can't take the 22% lower tax rate. So they don't benefit quite as much from the tax cut. There is a US FTA overhang. There are other issues like we're seeing with ranitidine, which will affect a lot of the players in India. So a lot of the negatives there are kind of likely to be. So not so interested there, but I think auto, which will also benefit quite substantially from the tax cut. Some of the NBFCs, we are very long Manappuram, for instance, and for a while now. So we continue to be liking those kind of players that have done well.
Well, Manappuram, Deepak, has been an outperformer this year. The gold financing companies, I think even Muthoot has done well, just that they had a bit of blip with regard to the strike that was, which took place in the state of Kerala. But management has highlighted the impact of that strike is only just about 4%. With both these stocks this year, they have given you returns of between 30 to 50%, and Manappuram in today's trade has been quite active. Deepak, would you take a bet in these companies where there are talks of government divesting its stake, be it BPCL selling to a MNC player, or for that matter Concord or SCI? There's been momentum seen in these stocks in recent past, and alongside that, of course, once again talks of Suti selling stake in ITC or Axis Bank.
That's I think the Suti stake sale needs to happen. Why does the government need to own so much of ITC or Axis Bank for that matter? There was a third company as well, I think L&T, but I don't know whether they still own much of it. But I believe we as a country should be very clear about what our priorities are, and I don't think our priorities are to own stakes in privately run businesses, Hindustan Zinc included. Why do we need to have that stake owned by the government when the government is suffering from a lack of money in order to boost infrastructure spending, in order to boost growth? Then they have to go and borrow from the market, which is meaningless because that eats into so many things when they already have this stake. I would also argue that the government needs to divest its holding in BPCL because or one of the three OMCs really. Because why does it need to own three OMCs? One is more than enough, but two would be a stretch, and three sounds like, okay, we had nothing else to do. We just bought three or we own three of the largest oil marketing companies in India. So I think it's useful for the government to sell it. I believe at the prices we are, BPCL or Concord might actually be attractive because held by a private player or managed independently of government supervision. This would actually be a very good thing for these companies. Even if they took it step by step and said, listen, we'll first do a corporatization, bring our stake down to 40%, get in a strategic buyer who can then buy the company over the next few years and then take it over. I think it's important for us to do that as a country, and I would, if you look at the opportunity, it would be in the likes of BPCL or Concor or SC. I don't know about SCI because SCI is a very different business, very cyclical in nature. But the other two are more, they have a bunch of assets which are undervalued because they're owned by the government. And if they aren't owned by the government, these assets will come in at a higher value. So we are long BPCL. I'm personally long a little bit of Concor. So I'm biased in that perspective. But ITC, I think, is a big beneficiary of the income tax cuts. And I believe that will, help it going forward. I just don't know whether, when the government stake sale happens, how much the hit will be. But if there's a significant hit, again, that's a good long-term purchase.
Right. Deepak, it's interesting that you spoke about ITC because that's exactly what I want to talk about. Well, let me just give our viewers a little bit of context here. I'm looking at this price to earnings ratio currently and, of course, FY20. And if I compare it to the 5-year average, the 2-year average and 10-year average, ITC's price to earnings is still lower than all these averages. What is also interesting is if you actually look at the analyst ratings on Bloomberg for ITC, well, 86% of the analysts, this is about 86% of the 39 analysts polled by Bloomberg have a buy on ITC, and the average return potential is 28% from current market levels. But Deepak, this has been the case for ITC for as long as I can remember now. The overhang of cess, higher cess, that hasn't really come about. We're looking at a lot of other advantages playing out for ITC as far as this FMCG, excluding cigarettes business is concerned, and yet this stock isn't really going anywhere. So what is it that's the overhang? It can't only be the Sooty stake sale.
Well, I think ITC traditionally has got a lower PE than a lot of the FMCG players because it has a very weird nature. The cigarette business is the most revenue generating and profit generating part of the business. It is relatively unaffected by rate duty hikes by the government because making cigarettes more expensive has not cut into revenues of ITC of the cigarette arm. It has largely been a drop in cigarette consumption in general, but perhaps India is getting more health conscious or something like that. But there has been a small drop only in the very recent past. But otherwise, price hikes have not really impacted it so much. But that's not the growing part of the business. The business that's growing is FMCG. There are two others. There's paper, where it is a significant player simply because of its size, but relative to ITC as a whole, paper is a very small player, and I don't even know why they're in that business. But there's also hotels, which is a significant, even A, it's a cyclical, and B, it eats up a lot of their capital. So their ROEs tend to be much lower because of their capital allocation to all these businesses, which somehow don't seem to give you the kind of confidence that you would have from one of the leading FMCG manufacturers in India and players, from a distribution standpoint, from a manufacturing and a brand standpoint. So I think if they had a plan to separate out these businesses, list them perhaps separately and create 4 units, then I think, you could give a much higher valuation to an ITC FMCG business and perhaps a cigarette business and give a lower valuation to something else. But given the way they allocate capital, I don't think they're going to get a much higher PE from where they are right now. But having said that, it's at a relative low compared to what it has traded in the past. And I think revenues will do very well in the next 1 year because of the tax cut, earnings growth. So there is perhaps an opportunity here for about a 1-year trade. I just don't know unless there is a management change to actually diversify or we move the businesses out of the primary ITC brand business, whether we will actually see the 80p or 60p valuations that other FMCG players get.
Okay, that's the view coming in on ITC, which is currently off the day's high, but still sitting with gains of about 1%.